Welcome to the Explainer. Today, we're diving deep into a provision that is absolutely fundamental for anyone dealing with property and taxes under the new regime, Section 82 of the Income Tax Act 2025. You know, if you're advising clients on real estate, getting a solid grip on this section is a must.
This is probably one of the most common questions you get from clients, right? Someone sells their home, they've made a nice profit, and suddenly they're staring at a pretty significant tax bill. The real question isn't if they can save tax, but how to do it properly, legally, and get the most out of the exemptions available.
And that's where Section 82 of the new Act comes into play. This is the roadmap. It gives you a powerful way to get an exemption on those capital gains. But, and this is key, it all comes down to following the rules and conditions to the letter. So let's break down exactly how it works.
So here's what we're going to cover. First, we'll get into the core idea behind the Section 82 exemption. Then, we'll look at the really critical stuff, the conditions and the timelines. We'll also explore a pretty interesting two-house investment option. After that, we'll run through a practical example, talk about compliance and common mistakes, and wrap it all up with the key takeaways.
All right, first things first, let's get to the heart of this exemption. Why does it even exist? Well, it's really all about encouraging people to reinvest in residential property. It's designed to help taxpayers maintain continuity in their housing.
The main principle is actually quite straightforward. If you're an individual or a Hindu undivided family, and you make a long-term capital gain from selling your house, the law says, hey, if you take that money and buy or build a new house, we'll give you an exemption on that gain. Simple as that.
Now, for those of you who have been in the field for a while, this probably sounds very familiar. And it should. Section 82 of the 2025 Act is basically the new version of the old, well-known Section 54 from the 1961 Act. The new law just streamlines the language a bit, but the core idea and how it works, that's all stayed pretty consistent, which is great for a smooth transition. Okay, to actually claim this exemption successfully, you've got to know the details inside and out. So let's really dig into the specifics: who's eligible, what qualifies, and the super strict timelines you have to follow.
Let's run through this like a checklist. First, who's eligible? Only individuals and HUFs. Corporations or firms are out. Second, what kind of asset did you sell? It has to be a residential house, and it has to be a long-term capital asset. And third, what are you investing in? It must be one residential house, and it has to be located in India. These 3 points are the absolute foundation.
Now the timelines, these are just as strict. You really have to pay attention here. For purchasing a new house, you get a window that opens 1 year before you sell and closes 2 years after you sell. If you're building a new house, you get a bit longer, a 3-year window after the sale. Sticking to these dates is absolutely crucial. Being off by even 1 day can get your whole claim rejected.
Okay, so we've established the general rule is invest in one new house. But like with many tax laws, there's a special exception. Section 82 carves out a really unique one-time option for people with smaller capital gains.
And the magic number you need to remember for this special option is this one: 2 crore rupees. This number is the key that unlocks a bit more flexibility for some taxpayers. So here's how it works. It's laid out in subsection 5 of Section 82. If your long-term capital gain from the sale is 2 crore rupees or less, the law gives you the choice to invest in 2 separate residential houses in India and still get the full exemption. It's a pretty neat option.
But, and this is a really big but, here's the catch. The law is very clear on this. This option to buy 2 houses is a once-in-a-lifetime deal. Once you use it, it's gone for good. As an advisor, it is so important to make sure your clients understand this before they make a move.
Okay, we've talked a lot about the rules in theory. Now let's get practical. Let's plug in some numbers and see exactly how the exemption calculation works in the real world.
Let's look at scenario 1. Here, the long-term capital gain is 1 crore. The cost of the new house is 1.2 crores. Now, because the amount you reinvested is more than your capital gain, you get to exempt the entire 1 crore. Your taxable capital gain? It drops to 0. This is the perfect outcome, the one you're always aiming for.
That's a great question, and it happens all the time. It's not always realistic to reinvest the entire gain. So what happens then? Do you lose the whole exemption?
Let's check out this second scenario. The capital gain is still 1 crore, but this time the new house only costs 80 lakhs. The rule here is simple. Your exemption is limited to whatever amount you reinvest. So your exempt capital gain is capped at 80 lakhs, and that leaves the remaining 20 lakhs on the table as taxable income.
Okay,
Knowing how to do the math is one thing, but making sure you're fully compliant is a whole other ballgame. Let's go over the procedural must-dos and some of the common mistakes that can trip people up.
There are 3 things you absolutely have to get right. First, the Capital Gains Account Scheme, or CGAS. Look, if your investment timeline goes past your tax filing due date, you must deposit the unused gain into a special CGAS account. This tells the department you intend to reinvest and it protects your exemption. Second, documentation. Keep everything. And third, make sure you report the exemption correctly in your income tax return.
And there's one more massive compliance point, the 3-year lock-in period. As you can see from this timeline, the moment you buy or build that new house, a 3-year clock starts ticking. You are legally required to hold on to that new property for 3 full years. Selling it any earlier brings some serious trouble.
And the consequence for breaking that lock-in is pretty harsh. The law has what's called a clawback provision. If you sell that new house before the 3 years are up, the exemption you claimed gets taken back. That capital gain that was originally tax-free suddenly becomes taxable income in the year you sell the new place.
Phew, we've covered a lot of ground. So let's wrap this up and boil everything down into a simple, easy-to-remember checklist of the most important points.
All right, here's your final cheat sheet. First, who's it for? Individuals and HUFs with long-term gains from a residential house. What do? Reinvest in one new residential house in India. When? Stick to the timelines. Purchase 1 year before or 2 years after, or construct within 3 years. Remember that special once-in-a-lifetime option for 2 houses if your gain is under 2 crore. And finally, the big one. The new property has a mandatory 3-year lock-in.
And that brings us to the final thought you should walk away with. With the new act in place, Section 82 is still the cornerstone of tax planning for property deals. The real key is to think ahead and structure these investments proactively. That's how you ensure full compliance and get the maximum tax benefit for your clients.
Thank you so much for tuning into this explainer. If you found this breakdown useful, please go ahead and like, subscribe to the channel, and of course, share it with your friends and colleagues.
This explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.